65k. So now the question 4 says, as a part of the expansion program to diversity its product, Crown Berhad plans to introduce a new product. The cost to produce the products is 400,000. So which means the investment cost will be depreciated over 8 years. This will be the lifetime, and bid on straight line basis to 0. Okay, the firm expect to sell 125 units, which means the quantity of the products per year at 10,000 per unit. So that's the price of the quantity per unit. Variable cost per unit and fixed cost are, so the variable cost is 8,000 and the fixed cost is 65,000 respectively. The firms require rate of return on the new products is 12%. So the discount rate is actually 12% and the tax rate is 28%. So we have to write down the every information given in the question. So investment cost will be the RM 400,000. Lifetime is 8 years. The quantity is 125 units. The price is 10,000 per unit. Variable cost and fixed cost. The variable cost is, the variable cost is 8,000. Variable cost is 8,000 and the fixed cost is 65k, and respectively the firm products, if 12%, rate of return will be the discount rate 12%, and return of tax rate is 28%. So after we gather all the information, we have to form a table. So what they asked to find over here is base case, best case and worst case scenario. So basically when it comes to base case, there will be the scenarios. There will be 3 columns. So first will be the lower case, which means the worst case. Center will be the base case, and best case will be the last one, upper case probably. So these are included with the information we can gather is quantity, price, variable cost, fixed cost, operational cost and MPV. With using the information, the question for 1, it asks to do the calculation for NPV. So basically it says the scenarios. It asks to calculate the scenarios for each of 3 scenarios given, best case, base case and worst case. So the first thing we have to do is divide the cases into 3 columns. So worst case, so this will be the lower. Base case will be the neutral, but it won't says here. So yeah, best case will be the upper. So for these 3 columns, there are a few informations are to be included in the 3 best columns. The 3 scenario columns. So the first information we have to write down and or put down in the calculation is quantity. Okay. Second will be price. Third will be variable cost. Fourth will be fixed cost. And fifth will be cash flow. And sixth will be the last one they asked to calculate, the NPV. Hold on, I think it cannot see here. Okay. NPV. Now, the worst case scenario, they asking to find the quantity. So there is a base case quantity over here is 125 units. The price for the 125 units are RM 10,000 ringgit. The variable cost for this is RM 8,000 ringgit. Fixed cost will be RM 65,000. And yeah. Now, these are the information they already given in the question. And now, the rest of worst case and best case, we have to calculate by our own. So the first calculation will be for the worst case, which means the lower case. The formula for it, quantity minus within the 10% they given over here, that's the one. So 125 minus 10%, you will get, sorry, hold on, 125 minus 10, will get 112.5. So this is the quantity for the worst case, 112.5. Second, best case, right here, same quantity minus 10%, within 10% is given, plus and minus. So 100 plus 100, and because over here they already given plus and minus, and plus and minus 10%, so it's plus and minus 10%. So these are divided into two, which is plus is for always for best cases and negative for lower or worst cases. So when you see here, it's lower cases. Now I'm going to calculate the 125 plus 10%. It will give the answer 125 plus 10%. 137.50. So the quantity is 137.50. This is the quantity value, the per unit for best case. So second, we are calculating the numerics for the price for worst case and also price for best case. So here they given the price about RM 10,000 based on the question information, and when I say it's the worst case, it's always the negative 10%, and the best case always be the positive 10%. So now we are doing for the worst case pricing, we have to somehow calculate the negative 10% of the value. So the price will be sorry. The value given, we calculate it's about 9,000 ringgit, and RM 10,000 for the best case. We have to plus with the 10%. We will get 10,000 plus 10%. Okay, 11,000. So we are going to put the value. I'm sorry, my phone is cannot place in one place, so I'm just putting it on the container. So I'm going to write over here. Best case is RM 11,000, and the other one, sorry, other one will be RM 9,000. So now we go back to the calculations. We are calculating for the next cost called variable cost. Same worst case, best case will be negative 10,000. This will be positive 10,000. And now the variable cost given over here is 8,000 ringgit, and the fixed cost given over here 65,000. Variable cost and the fixed cost, okay, yes, 65,000. So now we are calculating the worst case for variable. 8,000 ringgit minus 10%, 8,000 ringgit plus 10%. So over here is RM 7,200. This one will be plus 10%. Is 8,800. Okay. So now we are moving towards the fixed cost for worst case and fixed cost for best case. Same. RM 65,000 minus 10 percentage. RM 65,000 plus 10 percentage. So probably we'll get we will get 65,000 minus 10 percentage. So 65,000 plus 10 percentage of it, 65,000, 6,500. So 6,500 plus by 65,000 is 71,500, and 65,000 over here minus with 10% you will get 58,000 if I'm not mistaken. Hold on, 65,000 minus with 6,500. Yes, 58,500. So this is the calculation for the variable cost and fixed cost. Now we're moving into the equation type of calculation when it comes to operational cash flow. Operational cash flow. The formula says P minus variable cost, which means price minus variable cost, divide by the quantity minus with fixed cost. So basically it comes like this, and divide again with 1 minus tax rate plus with the I think it's depreciation tax rate. It's depreciation tax rate. Okay, depreciation tax rate. I'm not mistaken. So depreciation tax rate. So this is the formula. So now we are substituting into the formula. 10,000 is the actual price. We have to minus with the variable cost 8,000, and then we times again with the quantity. So we times quantity minus fixed cost about 65,000 plus the depreciation given over here is 50,000 divide by the tax rate 28,000. So sorry, 28,000 28%. So 0.28. We will get the answer. 10,000 minus 8,000, 2,000, 2,000 times 125 minus 65,000 plus 50,000 times 0.28. You'll get 147,200. For the NPV, so this I'm doing for the base case. NPV, the formula will be operational cash flow times with PVIFA minus with the investment cost. So operational cash flow, we already got 147,200. PVIFA for the base case, I'm checking over here. So 4.9676 minus 400,000. 147,200 times 4.9676 minus with 400,000, we'll get 331,230.72 cents. So this is the NPV for the base case. So as usual, we will be doing the same methods for other two cases, two scenarios. First, I'm doing it for worst scenario. So operational cash flow, P minus VC times with quantity minus fixed cost plus with it times with tax rate and plus with depreciation times by T rate. So we have to substitute all the information given over here that we calculated for the worst case and best case with using the plus minus times percentage. So price we got for the worst case is 9,000 minus variable cost we got 8,800. Quantity will be the 125.5. I'm sorry, the calculation is wrong. 9,000 minus 8,800, 100 and how much we got over here? 112.5 minus with the fixed cost 71,500. Just checking, something is wrong here. Oh, the fixed cost for the worst case is 58,500 plus with the depreciation given over here, tax rate $50,000 times by 0.28. So answer will be 1,000 0, 200, 2.5 minus 100 times 200 2.5 to plus minus 58 500 1000 times by 1 minus 0.28 plus 50,000 plus 0.28. Okay, RM 21,280. Hold on, I feel there's a mistakes here. 102.5 minus 58,000 is sorry, it's supposed to be 200 times by 102.5 22,500, so 22,500. Now 71,500 times by 1 minus 0.28. 1,280, yeah. So now we're finding the NPV for the worst case scenario. As usual, operational cash flow PVIFA minus with 10. So 21,280. PVIFA is just now we found about 4.9676 minus 10. You'll get 50,571 53 cents. Now we are finding for the best case. So operational cash flow, price minus variable cost, quantity minus fixed cost, times with tax 1 minus tax rate, and plus with depreciation tax rate. So the price we got for this is 11,000. Variable cost is 8,800. Quantity for the best case 137.5 minus fixed cost for the best case 71,500. Minus 0.28 is the tax rate. Depreciation as usual 50,000 with the tax rate. So here we can get the amount 11,000 minus 7,200, 8,800, 2,200, 2,200, that's 137.5. So minus 58,500 times 0, 1 minus 0.28. 11,000 minus 7 to 8,800 times by 97.5, 2,500, 244, 244, 0.28 plus 50,000 to 8. That's very hard. So you get amount 348,000. The NPV for this session operational cash flow times it PVIFA minus 10. So RM 348,080 times it 4.9676 minus 10. So we get the amount. That's 329,122.208. So this is the NPV, operational cash flow, fixed cost, variable cost, pricing, and also the quantity for the worst case and best case. So we just have to imply or just to substitute all the information in the table. So now we have to find the question Roman 2. It says what is the sensitivity of the base NPV to changes in unit price. So as usual, we already found out the operational cash flow. It's RM 147,000 200, 147,200. Now they are asking for the sensitivity changes in unit price. So we have to take the assumption price for the new operational cash flow calculation. For an example, we are taking what is sensitivity to base? Okay. Assumption price. RM 14,000. We have to substitute onto the operational cash flow 14,000. Sorry. 14,000 minus with 8,000 125 the quantity minus the fixed cost, 1 minus fixed tax rate plus depreciation amount 50,000 times with the tax rate. Okay. $14,000 minus 8,000 times 125 minus 65,000 685,000 times with 1 minus 0.28 then plus 50,000 times by 0.28. So 50,000 times 0.28. 14,000. So 14,000 minus 8,000 times 125 minus 65,000 times with 1 minus 0.28 493,200 plus with 50,000 times 0.28 14,000 plus with 493,200. So the new corporation cash flow will be 500,700. So to find the sensitivity, we take the assumption price of the operational cash flow 507,200 minus with the base operation cash flow 147,200 200 divide by the price 14,000 for the assumption, 10,000 for the base. So finding the amount for this minus 147,200 360,000 14,000 minus 10,000 basically 4,000. So 360,000 divided by 4,000, the value is 90. Sensitivity is 90. We underline this. So we move on to question 3rd Roman. It asks to find accounting break even level output of this project. Okay, to find this, the formula for break even for accounting is fixed cost plus depreciation divided by price minus variable cost. So they are asking for the level of the output on this project. So we have to take the base price given in the question. So fixed cost 65,000 out of ink. 65,000 plus 50,000 divided by 10,000 minus by 8,000. So 65,000, 100 and 11,500, 115,000, 100,000. You will get 11,500. Sorry, 14,000 minus 2,000 divided 2,000. 57.5 is the break-even level for accounting. Okay, that's question Roman 3. Now move into the Roman 4. It asks to find the degree of leverage. Of the accounting break even. So degree of leverage, there is a formula for degree of leverage is 1 plus fixed cost divided by the depreciation. So 1 plus 65,000 divided by 50,000 1,000 plus 1. 2.3% is the degree of leverage. So when we see the question number B, the same question 4B, discuss the standalone principle in the project evaluation. So they are asked to state down what are the principle are using in the question in the project. So basically, this is the project of the cash flow and the performance is being analyzed independently without consider the financial interaction. So that means it says the plan or the project has the own revenue, expenses or the investment required without the considering the financial interaction with others. So must write this project has its own expenses, revenue and the investment. So what happened here? The operational cash flow play a role independently. Hence, analyzed without considering the financial interaction. That's all. So that's all from me, Kumaresan. Discuss or demonstrate the calculation for question number 4. Okay, now I am demonstrating the calculation for question 5. Question 5 says, 5a says, define synergy. Synergy is basically a combination, value and the performance of two companies. So this is not both, it's two companies. Two companies. So it's been greater than the sum of their individual values, and the merger, which means the goal merger of the synergy, and achieved through the cost saving, increase in market shares, and enhance the operational efficiency of the companies. So that's what basically is a synergy. And B question asks to explain the following defensive tactics. So we have the three popular tactics being used in the corporate world. The first is the corporate charter. Second is the golden parachute. Third will be the white knight. So the corporate charter basically say it's a documentation outlining. It's a document outlining the rights and the responsibility of the shareholders, directors, and also the officers invested in the company as well, or in the firm. So in the corporate world, these are the corporate charters, which means they have the legislation of the own company to be come out with, to be responsible for them to be have rights in the corporate world. So that's what basically is the corporate charter. Second will be the golden parachute. Golden parachute is actually a compensation package which is provided to the two top executives, to top execs, to merges the organizational types. So that golden parachutes, which means it could be also called as the law of attraction to the executives, to the execs. So what they usually do, they will get a compensation package to the top one to merge the organizational types. Basically, it is to enhance the corporate profit as well for the firm. And the third one is white knight. White knight is actually a tactics or a defensive mechanism to save the targeted company from hostile takeover. For an example, when I can say here, the CEO of Google Corporation, the CEO of Google Incorporation. So what they usually do, this company, this corporate multinational company usually go around the world and try to get the try to target a company, and it attacks the company in the value of corporate, which means they will take over the company, which means the CEO travel to a company. If you target the company, they will hostile, which means they will take over the firm. So this white knight is actually to save the targeted company from a hostile takeover. Okay, so question C, 3 marks question. Question C, it's saying Sarah Y Corporation is bidding to take over Balisha Berhad, and Sarah Y have 30% of share outstanding. So they have the 30% of the share for Sarah Y and selling at the 50 ringgit per share. So they're selling 50 ringgit per share of the 30% of the outstanding shares. So whereas Balisha has 20% of share outstanding, selling at 17.50 ringgit per share. So it's 17.50 ringgit included with the 20% of the outstanding share balance will be selling for 17.50 per share. So Sarah Y estimates the economic gain, the merger, to be 100k. So 100k is the economic gain, which means estimated economic gain from the merger, 100k. And basically the acquisition price for the Sarah Y is actually 10 ringgit. So they asked to calculate the value of Balisha to Sarah Y. What is the value of Balisha to Sarah Y? Basically, to find the value of Balisha to Sarah Y, what we usually do is we have to find the what we call that. We have to find the current market value times the economic gain at the first place. So this 350,000, which is current market value 20k, times with the 17 value shares per share 17.50. So this will be the current market value of Belicia. So when Belicia has the current market value around 350,000 to be selling out there, which is she have the market value of the shares into her and it's about 350,000 plus with the estimated economic gain 100,000. So basically this 350,000 will be the market value of the share she holds, and 100k is the economic share, which means the economic gains. So wherever the gain or wherever this market value increase day by day, which is have a gain by the economic scale, they'll providing her 100k of the value, which means it is an estimated value. It could be go down and it could be go up, but in this case they are fixed about 100k. So when we total together 350k plus with 100k, so this will be the value, which means the market value Belicia to the Sarah Y, 450k by the end of the end of the share. She have to come up with the profit around 450,000 ringgit in Belicia's hand to Sarah Y. So question 1 done. Question 2, which means Roman 2. I'm so sorry. Where's the PDF? Okay, question 2 is asked to find if Belicia can acquire her share for 20 ringgit per share. What is the MPV of the merger to Sarah? Okay, it's question asking if she already have 20,000 of the outstanding shares on her hand. If the share per share, which means the 20,000 of the per share is 20 ringgit, it given the question, what will be the cost of acquisition for Belicia? Basically, we have to take the outstanding shares of Belicia, yes, times with 20,000 given the new acquired share per share value. Her cost of acquisition is 400,000, 400,000. So the NPV that acquired to merger to Sarah will be 450k, which means the cost of acquisition from Belicia basically, where is it? 50,000 from Belicia. Belicia to value of Belicia to Sarah Y, which means her current market value minus with the cost of acquisition, which means her new 20% of the per share given or acquired. So we will be getting the net present value of 50%, but that Belicia can acquire to the merger Sarah Y, 50,000. So third question will be, how much will be the price of Sarah Y per share in the market after the acquisition? So they're asking what is the price after the acquisition. So basically to calculate it, we have to calculate the market value of Sarah Y Corporation. 30,000 is share of outstanding. 50 ringgit is the per share value. So when we times together, that will be the 1,500,000 will be the market value of Sarah. So we have to find the, what we call that, share a market after the accusation, so that we take the market value, current market, the market value of Sarah Y, current market value of Sarah Y 1,500,000 plus with the value that Belicia sent as a merger to Sarah Y 450,000 minus with the cost of accusation of Belicia acquired 20 ringgit share from the major to Sarah Y, because they're asking after the accusation. So which means she have to come out with a new share value 20 ringgit included and acquired with the NPV. So this calculation shows accusation after the market value. Market value after the accusation. So it will be the value 1,550,000 of market value of Sarah. Now we have to find the total number of shares in second step. This is step 1, step 2, step 3. So step 2 says they both have 50,000 shares in their hand, outstanding shares. So to find the price after, which means price after the accusation, is the market value after the accusation is total value after accusation divided by new share outstanding. This will be the both share included 50,000, and also the market value of the Sarah after the accusation is 1,550,000. She'll get RM 31 per share, 31 ringgit per share. That's question, Roman number 3 says. Now they asked to find what is the net present value of the merger to Sarah Y when it uses an exchange of stock. So this will be step 1, step 2, step 3, 4, 5 and 6 will be the net present value. So to find the exchange of stock, we have to calculate the exchange ratio. What is the exchange ratio after the accusation acquired to Belicia is 20 ringgit per share? And what is the ratio, what is the per share value for Sarah Y is 50 ringgit. So basically is 40 ringgit is the 40 cents is the exchange ratio for Sarah Y. So new share issued, which means we have to take Belicia's, let me confirm back. Yes, we have to take Belicia's outstanding share times it the exchange ratio, which means new share issued. We have to times with the exchange ratio. So we basically will get the new share outstanding for Belicia is 8,000 ringgit. So total share outstanding, the third step will be total share outstanding divided by total share outstanding post merger. So this will basically, we'll take the Sarah's total share plus with new share issued to Belicia 8,000. So 38,000 is the post merger outstanding share for Sarah Y and Belicia. So no market value per share post merger. We have already gotten the 1,500,000 is the market value of Sarah, the new one, and plus with the share post merger 100k. So answer will be, hold on, yeah, 100k. So answer will be 1,600,000. So new price per share is we have to take the new market value per share post merger 1,600,000 divide by the total share outstanding post merger 38,000. So we'll get the new price per share is 42 ringgit and 11 cents. So the net present value for them is 100k divided by 2, 50,000 is the net present value. Okay, I'm demonstrating the calculation for question 6. So basically, question 6a says, Halton Group is considering one of the two manually exclusive projects, which is Vogue and Famous. The after-tax cash flow for the projects are as follows, which means they have 6 years of projected value years, and Vogue, which means the cash flow for Vogue and Famous will be the amount will be stated here in the question. So now, assuming of the cost of capital is 12%, and they are asked to find the calculate payback period, net present value, profitability index, and interest rate of return for Vogue and Famous. So we have to find for the Vogue at the first place. Now, what is the Vogue cash flow given in the project? All the project values cash flow are the same, 50,000 from year 1 to year 5, and there's no value on year 6. And the famous what do you call that, cash flow, year 1 is for 25,000, year 2 was 35,000, 60,000 for year 3, 54,000 for year 4, 38,000 for year 5, 30,000 for year 6. So basically, when we start the payback period for Vogue, we have to calculate from the year 1 to year 2, year 2 to year 3, year 3 to year 4. So year 1 is basically given it's 50k, year 2 is 50k. So what we can see over here is it's already 100k, right? So when it reaches the 100k, we again come to year 3, which is 50k. So the value will be 150k when we plus together. So for 3 years value is 150k, is already comes to the accomplishment of the investment value 160,000. Okay, so this 160,000 to get the 155 is already in the third year. So the balance to get the value to accomplish the payment of the investment 160k is 10,000 ringgit. So over here, 160 minus 150, basically 10,000 ringgit. So we have to payback period for paying the 160 back is on 4th year. That's why we have to demonstrating the calculation 50,000, 50,000, 100,000, and another 50,000 will be 150,000. So this 160 minus by 150, 10,000 is the balance. Okay, we can get the 10,000 in year 4. Year 4 is the 10,000. So year 4 is recover from the balance 50,000. That's the correct. That's the year we have to pay back the period of 160,000 back. So 3 years, 50,000, 3 years plus, because we already gotten the amount in 3 years, plus balance of the payment on 4th year is 10,000. 10,000 divide by 50,000, because all the cash flows projected over here is 50,000. So basically they can pay back all the amount in 3.2 years time. That's the question 1, calculating for Vogue. Now we are calculating also for Famous payback period. Their cash flows are starting for the year 1. They have to pay back the amount is 220k. 220k. When they comes to the business, the cash flow for year 1 is 25,000. The cash flow for year 2 is 35,000. When you calculate together, we already got 120,000 in the hand. So 120,000 plus with another 60,000 in the year 3 will be 180,000. So year 4, it goes under 54, another 54,000. So it's almost already already comes to an understanding that when we calculate all the when we sum up all the cash flows until 4th year, we will get the amount of 234,000. So it's already can exceed the amount of 220k they have to pay back later, right? So this 230k can be paid in 4th year because they already got 234,000 in 4th year. So what are the balance we can see over here is in 4th year 234, wait, okay, says 40,000 they have to take out from 4th year to accomplish the 220,000 over here. So 25, 35 plus 60 for 3rd year. So another 40,000, 160. So recover from 54,000. So it's already stop where in year 4. So 3 years gotten the money, and year 4 taking the balance to get back the 220k, to pay back the 220k. So 3 years plus 40,000 divided by the amount they stopped, which means the amount they stopped at year 4, 54,000. So they can pay back all the around together in 3.74 years. Now we already find the payback period. Now we have to find the net present value. So net present value for the work. So wait, let me underline it. Sorry, yeah. Okay. Now the net present value, the formula is cash flow divided by 1 plus the rate of interest square power by time, and minus all together with the initial investment. That's the formula. So the initial investment is 160,000. Cash flow is 50,000. Their assuming rate of the cost of capital is 12%. So when we calculate together, we will get the amount of 20,238.79 of the net present value for work. And when we do the same thing for famous, we'll get the negative 55,991 for the work. So now we have to find the profitability index. To find the profitability index, we have to see the formula for profitability index, which is present value of future value divided by initial investment. So what is the present value we gotten for 180? Okay, what the present value we gotten for the work is 180,238.79 cents. So we have to round off. Hold on. Okay, so future value for work is 180,238.79. 283 ringgit round off after round off, and divide by the initial investment is 160,000. And now for the for famous, there will be the 164,000 is the present value of the future value cash flow, 164,009, and their initial investment is 220,000 ringgit. So the profitability index is 1.13 for work, and 0.75 is for famous. And we have to find the internal rate of return of the project. So rate of return, basically we have to come out with the initial assuming rate 12% until it is increasing, because when we see the profitability index for work is beyond zero, which is above zero, so we have to tell it is greater than the zero. Okay, greater than the zero. So rate of return 12%, the MPV is greater than the zero, thus the rate of return is greater than 12%. When it comes to 14%, when the MPV is greater than zero, thus it is also greater than 14%, where it is increased again 16.5%. And the MPV is greater than zero, the IRR is still greater than 16.5. But when it comes to 17% of the rate of return, assuming the MPV will be negative 49. So the rate of return for internal rate of return for project work is 16.9, because 17% is already comes under the negative value of the net present value. So the before that is 16.9. We have to take the initial internal rate of return. So the same thing we're going to do for famous. So assuming 12%, since the profitability index is below 0.75, it means the value of the MPV is lesser than 0. So 12% lesser than 0, MPV lesser than 12%, and 10% we have to decrease it. Also, this famous company net present is negative, and then lesser until we get the negative amount 5169. When we put 4.5 interest rate, cost of capital. So the interest rate, internal rate of return for the project famous is 4.5%. So determine the best project that Halton Group invest. So basically, famous is already have the profitability index below 0, and they have a net present value in the negative value, and the rate of return, internal rate of return, is 16.9 for work and 4.5 only for famous, since the work has a short payback period and the higher net present value and high profitability index. So the internal rate of return for work is more than the cost of capital. You see, 12% cost of capital and 16.9 is more than 12%. So basically the cost of capital is greater for the work project. So I will say the project Halton Group should invest is work. Project Halton Group should invest is work. So now we are moving on to question 6B. Sorry, this is 6B. Okay, sorry. NGO Holding Center, NGO Holding Berhad plans to install a new machine P and Machine Q. The cash flows of the two mutually exclusive machines are as follows. Machine P have 4 years of depreciation years, which is 600,000 initial investment for the Machine P, 350,000 for the first year, and until fourth year 350,000, and also for Machine Q 900,000 is the initial investment, 450,000 until the fourth year. So they asked to calculate the crossover rate of two machines. When we see the differences between the two machines is 100,000 and the initial investment is 300,000. I'm sorry, 300,000. So what we have to do is right now we have to calculate the net present value. So 300,000 plus 100,000 over, because I'm totally cannot understand the question B as well. So I just did the net present value as a cross rate of two machines. So the cross rate of two machines, when we can see the differences is cash flow is 100,000. So the net present value for the both machines are 300,000 at the initial investment differences in the cash flow, 100,000 divided by 1 plus rate of return and power by the until 4 years. And what we can see is 300,000 plus with 100k over 1 plus rate of return we don't have given over here. So we're just assuming there's no rate of return. So 1 power of 1, 1 power of 2 and 1 power of 3 until 1 power of 4 will give the net present value is 12.59. Let me confirm that. 300,000 plus 100,000, sorry, 100,000. This will be the initial investment. It means they have to pay back all the amounts. So it's converts under negative. Divide by 100,000 divide by 1, also 100,000, 3, also 100,000, also 100,000. So negative 300,000 plus 1, 2, 3, 4, 400,000, 700,000. Negative 300,000 plus 400,000 is still we get the amount of 100,000. This will be the net present value for the both companies. Divided by 1 plus 0 plus 4. So I can get the net present value is 100,000 for the question 4B, because I'm not sure how does it going to get the cross rate of the two machines. So I'm assuming that the net present value for the question 4B for the both machines are 100k.